Good morning, everyone. We are here today to hear from Supreme PLC, who yesterday announced their interim results to the end of September. We're going to hear from Sandy and Suzanne as they talk through the numbers and strategy, and then there'll be an opportunity for Q&A at the end. Feel free to submit questions as we go along or at the end as you see fit via the Q&A function. Without further ado, over to you, Sandy.
Yeah, thank you, Hannah, and thank you for joining the call. If you'd like to flick to the first slide for us, Hannah, if you don't mind. Okay, so just those guys that are on the call don't know who we are. Supreme, since 1975, established, and we are today a manufacturer, a brand owner, a licensee, and a distributor of stapled, fast-moving consumer goods. So we deal in products that are sold day in, week in. Doesn't matter what the weather's like, doesn't matter what the environment's out there. These products are always in huge demand. What you see here is our team. Suzanne on the call today, who's joining us as our CFO, and a little bit about the team is every vertical, every product category that we're in has a divisional lead, and the divisional lead has been with us since all of them actually, since we started those categories. So we've picked the right people, and these guys are incredibly talented. So I come here and talk to you, and it looks like I'm doing a lot of the work. Actually, these guys take a lot of pressure and make most of the decisions. I literally just back them up when they have come up with ideas. I literally just support them with them. So I just wanted to sort of touch a bit about that really on the team. And Andrew's been with us 30 years, David's 13 years, Mike's 7 years, and Dan Clark since we started the wellness category about 3.5 years. So just moving on to our highlights here. I'm actually not going to say very much on this because we got it further down. And on the history, for the guys that have seen the last podcast, will have a really good idea. And if you haven't seen it, I cover the history off a lot better on there, and I'm not going to do it again because I want to sort of have more time for your Q questions and answers. But just those that haven't been on there, I just want to just quickly pan out what has happened over that journey. Is that we started our business career in batteries, and we started as a distributor. We then moved into licensed batteries, which is then licensing the brands like like JCB. And then we moved from a licensee on batteries into a licensee in lighting, a completely different category. And we did that really successfully from 2007 to 2013 as a licensee, and added more licenses on lighting. And from there, we moved into actually being a brand owner, which was our own brand of vaping. And from vaping, we moved into sports nutrition and wellness. So we've had a transition across 4 categories: batteries, lighting, vaping, and wellness. And one thing that pulls all these categories together, because they look quite different, is actually the customer. And for the customer, it's the most profitable part of their store. So when you look at our bad debt ratio, we lost 20 grand of bad debts last year on 122 million of revenue. It's because we get paid so fast, because our products are so profitable for their stores. None of the retailers, doesn't matter which field they're in, whether it's convenience, whether it's hardware, DIY, discount, we are so profitable for their stores. So we are equally as important for them as they are for us. And for our top 10 customers, we manage their EPOS data. So we manage their sales out data. So we know the trends were happening as they happen in real life. Just moving on to the next slide. This is our vertically integrated platform. This is where we have a shared overhead base. And this is what's, I would say, more unique about Supreme, is that there's very few businesses that have categories then have a very shared overhead base. And so when we move into a new category, like we did recently with vitamins, we come across other vitamin manufacturers, and we have a slightly unfair advantage because our route to market into that industry is so much lower than a new company coming in just selling vitamins and wellness, because our distribution is already paid for, our finance team, our sales team, our marketing team are all shared. So I could give you the sales and gross profit by batteries, lighting, vaping, wellness, but I couldn't give you the net profit because it's so much shared overheads. And this is what we do really well. When you look at one of the acquisitions was Cymex we made recently. We, within 2 weeks, closed down their warehouse. We bought their brand and their stock. So we closed down their warehouse. We brought their stock over. We've employed 2 people that run the Cymex division. So we've gone from 25 people to 2 people, and we've gone from a DC that was somewhere else into our own platform, supported by our own marketing team, sales team, etc. And we're able to do that because of this platform. And that's the bit where we will carry on leveraging in years to come. And that's when one of our categories starts slowing down, and all categories eventually will start slowing down once they peak, we'll introduce a new category into our 3,500 customers that sell into about 40,000 outlets. And that's pretty much, I would say, very unique about Supreme. And the shared overhead services also extend into business online. I mean, they share the same marketing team, they share the same finance team. So it is really integrated across all our different categories, which is our unique point. Moving on, Hannah, if you don't mind. Suzanne, I'll let you cover this one, if that's okay.
Yeah, no problem. Good morning, everyone. Thank you for joining us. For those of you that don't know me, I'm Suzanne Smith, the CFO. I'm going to largely be focusing, as you'd expect, on some of the financial slides, but let me just give you a bit of a canter through what we believe to be our kind of key investment highlights. You'll see them listed there on the slide. So if I take you through each one, we talk about having a winning business model, and that's principally because we have so many elements to our business, and those elements are different categories. So batteries, lighting, vaping, are different elements of supply chain, whether we are distributing under an exclusive license, whether we're manufacturing. And the benefit of having so many different facets to your business is that macroeconomic factors don't tend to take the entire business. They take elements and the impact elements of your business at a time. And in times where we are now, in terms of kind of freight and shipping or raw material price increases, this is the luxury of having these different relatively independent elements to our business, that it doesn't kind of take the business out at its knees. So this business model, this formula of having lots of elements, is definitely paying dividends, excuse the pun, at present. It's also further exemplified by the fact that our supply chain, it really belongs to us. You know, given that we manufacture 60% of our gross profit comes from items that we manufacture. 70% of our revenues come from brands that we own or that we license exclusively. It means that we are largely in control of our own destiny. And people often talk about Supreme being resilient, and this is why we believe the business is so resilient, because it's very much in our control. And then when you overlay that on an extensive and very lucrative distribution channel. Some of those customers, our largest customers in particular, have been around and working with us for kind of 30 plus years. It's actually, as it says there on the side, it's a really privileged access to such an extensive distribution network. You put all that together and people say, so who are your competitors? And there's nobody working in the segments that we work in across the elements that we do to the extent and for as long as we have. So that's why we believe our business model to be winning, and it being unfair to the rest of the competitive landscape. And we've had really strong growth credentials historically. The business, even in just the last 5 years, has grown revenue around 15% a year, and EBITDA more like 20 and up to 25% a year. And the reason that EBITDA is kind of outpacing the growth of revenue is because we've had this two-pronged attack and two-pronged approach for our growth, which has been to grow top-line revenue, introducing new categories, winning new customers, new product development, but at the same time working just as hard on our cost base as we are doing on our revenue base. And that's largely been through manufacturing and the inroads we've made there in terms of wanting to expand that gross margin. We've also now really established this, I mean, I don't know whether cookie cutter is the right word, but we've done this 3 times now with vaping, then sports nutrition in terms of protein powders, and now most recently with vitamins, which is we enter new categories as distribution, and we then step back into the supply chain to really expand kind of our gross margin and therefore our EBITDA potential. And all of that mean when you combine that really with the fact the business is fairly capex light, And this approach, we think, is fairly de-risked. It means it generates real above average earnings, especially then when you start to layer in M&A on top of that, which is something that we've done with increasing velocity, even in just the 9 months since we've been listed. We also think, in terms of the products that we sell, that it gives the business real forecastability, meaning there's such cyclical, sticky, repeat purchasing behaviours exhibited by the types of products that we sell. It means it's very easy to forecast the revenues. You know, the seasonality hits us in the same ways each year. It means that whether it is whatever the weather is, whatever the economic circumstances are, global pandemic or not, freight, shipping, whatever those kind of macro factors that might be impacting us, whatever is going on in that wider environment, there's still real certainty that the kind of products we sell through the distribution channels that we sell them through, that they will virtually always be in a consumer's basket week in, week out, which gives the business real stability and certainty. And then combine that with, as Sandy said, you know, that depth and strength of management team, many of whom have been here a long time and are real experts in their field. Combine those people with a real sensible kind of deployment of resource, whether that comes to the M&A that we do, and really being able to identify valuable complementary brands that can come and sit alongside the existing Supreme business, whether that's the way that we manage working capital, whether that's being very low leveraged. It means that the balance sheet has been stronger year on year in recent years, and it's low geared, which means we deem that to be a really sensible use of capital. So that's how we summarise our key investment highlights. In terms of financial highlights for this period in particular, and we'll come on to this in some more detail when we get to the finance slides, but you'll have seen from the RNS that we published yesterday that every metric across the board has gone in the right direction in this 6-month period. Revenue is up, gross profit is up, both in absolute terms and also as a percentage of sales. EBITDA is up, net profit is up, we've generated more operating cash, we've continued to service and pay down our bank borrowings, and our balance sheet has strengthened. So there's, you know, we've checked all those kind of financial metrics in the right direction. The standout metric is definitely EBITDA, and this comes back to this point of growing revenue but managing to grow your returns even more substantially, and that's primarily been done in this half year because we've been really focused on those two categories that deliver us the highest gross margin percentages, being vaping and sports nutrition, that Sandy will come on to it in some more detail. But yeah, I'll talk you through the financial highlights when we get there.
Yeah, so operation highlights. So the big things that happened since we probably last spoke was we've had 2 acquisitions that are now embedded. Bendec in Ireland, that's a battery and lighting distributor there. And more recently, the Cymex Sports Nutrition, which we've only had maybe 2 or 3 months of trading in the first 6 months. Both have been embedded properly. I can say with confidence at the moment that we have maintained all the customers at Cymex. We were really concerned of losing some. At this moment in time, virtually every major customer is still buying from Cymex from us now than they were buying before, when Cymex was in its own entity. We've launched 2 vitamin brands and a private label in vitamins. So just when I say launch, we've actually launched Sea Lions end of July. I think it was 19th of July. We launched back end of July. Millions and millions. We are launching in terms of, we've got soft listings in some of the retailers, in one of the main retailers in particular, but we're going live in mid-January, and I'll come on to the campaign that we're doing on Millions. And the other area is we've also started to now manufacture vitamin C. Was our first product we've made in-house, and that will hopefully over time start delivering more margins as we scale up our manufacturing of vitamins, and hopefully the sales will take off as well at the same time. Yeah, I just wanted to touch on the supply chain, just seeing everyone's question, like, you know, what's happening. You managed to still maintain and grow gross margins. It's not been easy. It's been really challenging, but we've got a really dedicated, loyal, but also very hardworking and very smart team that have navigated everything that we needed to navigate. And we've, from the outside, it looks like a swan, you know, we've sort of elegantly delivered this, but we have been, you know, pushing it underneath the water, pedaling as fast as we can to make sure that none of the macro factors affect us all, have disrupted our ability to deliver our results. Okay, the next slide, please. Yeah, financials.
Okay, right. So let's start at the obvious place with the income statement. As I mentioned in the highlights, you can see as you cast your eye down the right-hand side on the change column, all the metrics are moving in the right direction. It's been a very strong performance for the 6-month period. If I just delve a little bit deeper in terms of revenue, you can see there that revenue grew almost £5 million, 9%. It's important actually to break that down into a few different elements because there's ups and there's downs in there. So if you combine the growth from M&A and from underlying organic growth of the business, together those account for about £8 million of growth year on year. That equates to 15%, and that's in line with the CAGR that we have reported and consistently reported over the last 5 years. So the business has continued on that same trajectory of growth, and we'll come on to when we get to the segmental slide which categories and where that's come from in particular. The other point to note that has characterised growth in the period is lighting. Lighting is actually, as a category, has grown to just over £2 million in the period, and that equates to 18% of growth. We determine about half of that is actually a timing benefit where we've simply brought forward invoicing into the first half that we would expect to see typically in the second half. So it's worth just bearing that in mind when thinking about how the second half will perform. And then it would be remiss of us not to mention the reduction in the household category. That's reduced by £4 million year on year. Now, we knew that there would be some COVID reset in that category. For those that have seen our website and know the kind of products that sit in that range, it is dominated by domestic cleaning products. Now, understandably, and as we talked about on this roadshow last year in July, we knew that had a great year because we were all cleaning our houses like maniacs for many months and stocking up on all those kinds of products. So it took a real bounce. So what we, as expected, what we saw this year is that has reset to kind of its pre-COVID levels. And then there was also a particular part of the range that Poundland was stocking and taking from us that they have now brought to market their own brand rather than it being a branded product that we were selling them. So that has kind of amplified it a little bit further. What you don't see in the household category, because we only report by category down to the GP level, is the net return that we deem that we have driven from the household category. So this time last year, the category was standalone. It was operating in its own warehouse in Blackburn, kind of 45 minutes up the road, with its own management team, its own sales team, purchasing, because we just bought the business. We bought the business in February 2020. So for that 6-month period where it was extremely buoyant and everybody was flat out busy, it was not the right time to try and integrate that business back into Supreme. But we have done that since then. So the household category now sits and lives with the rest of the business in Trafford Park. There's no dedicated sales, finance, purchasing. It now is supported by that single vertically integrated platform that we talk so richly about, that its gross margin is now its net margin, which wasn't the case last year. So we estimate that household category on a net basis is delivering the same return as it was kind of pre-COVID. You'll see there, if we move on to kind of gross margin, you'll see gross margin as a percentage of sales has increased from 25% to 30%, which is a great result. And that's because, as I said earlier, we've really focused on vaping and sports nutrition, our manufactured categories, which today now account for 60% of the total gross profit in the group, and that compares to 55% in the year before. You'll see that administrative expenses have also increased in the period. What's important to note, and I'm really keen to convey this message, is that pre-IPO, this business was owner managed and it had a very lean and very tightly controlled cost base, and that is absolutely still the case today. It would be forgivable for you to glance at the increase and assume that actually the business has kind of fattened up in the period. It absolutely hasn't. The increase in administrative expenses is largely two things. One, some of those admin expenses, largely selling expenses, just grow as revenue grows. So carriage, distribution, commission, selling fees, and in particular listing fees. Now, listing fees is a fairly new concept to Supreme. It doesn't really happen in discount retail, which until recently was, the majority of our customer base. But the grocers like to hit you with listing fees when you begin listing a product with them. You'll see in our analysis we've done before that Sainsbury's has become a big customer it's become a customer for Supreme, and will hopefully become a big customer in time. It now lists vaping. We also, with the onset of Cymex, inherited Tesco and Morrison's, and some work from Sainsbury's as well. So listing fees have taken a step up in the period in particular, but the vast majority of the increase has been more around people, particularly around our board. So pre IPO, I wasn't here, we didn't have a chairman and non-execs. We weren't obviously having to incur fees around brokers and nomads and the extent of insurance and even audit, tax, legal. All of those professional expenses have all taken a significant step up post IPO, totally kind of outside of our control. So what we've seen is a step change in that expense base. It's not the start of a trajectory, it's been a step change. The only thing that we really expect to continue to grow in line with sales is selling expenses. We've also highlighted as well the adjusted items. It's just important to note there that actually for this period they net to nothing, but there are some sizable kind of charges in there, particularly share-based payments, and we'll see that charge come through each half year for the next 3 years. And then our fair value charge, which is extremely volatile, hence why we adjust it out. Today, for this period, happens to net off with the other costs that are in there. In another period, I would expect that to be a charge to the income statement. Thereafter, kind of operating profit after tax falls down kind of down the P&L as you would expect. Our kind of prevailing rate of taxes is back down at kind of 19%, so as you would expect. If I move on to the segmental breakdown, so in here, if we just take it category by category, you'll see that batteries hasn't really moved year on year, and that's a function of two things. You'll remember that last year batteries took a nice step up as a result of COVID, and we expected that to reset back down. It hasn't done, which has been very pleasing, but also we've taken the benefit of the Vendec acquisition, the Irish lighting and batteries business that we acquired in the period, which has helped the margin a little bit. The margin on batteries is now around 11-12%, whereas previous to that it was more like 10. Lighting, I've already explained it, it's grown by 18%. Half of that is the underlying organic growth of the category, which is a pleasing result, and the other half is some timing that we'll see unwind in the second half. Vaping has had another very strong period. The growth in that category has been entirely organic. There's been some customer wins that we've had in the period that we've reported to you previously, and they will start to build over the next kind of 18 months to 2 years. But yeah, they've definitely bolstered the category in terms of having those customers on our roster now. But the element of vaping that has grown most successfully and most importantly is our kind of hero product, our 10 ml liquid. That's where the EPOS data week in, week out continues to be displaying double-digit growth across all of our large retailers, and that's the most profitable part of our business. That's the part we manufacture, where the gross margins are the highest. So that has been really pleasing, and it shows no signs of slowing down. So that's definitely contributed to the performance. And then in sports nutrition, we've seen the category triple year on year, which has been again another very pleasing position. I must explain that the half year last year was quite low, because that was a 6-month period we're in lockdown, and we saw sales come off a little bit in the first half last year. So it's a slightly unfair position on the basis that we're comparing it to a slow half last year. Nonetheless, the category has grown through M&A, which we'll talk about as we get onto the sports nutrition category later. We've launched 2 new brands of vitamins, and we've had about half of that growth has just been underlying organic growth to existing customers by new product development, increased SKUs, you name it, right across the board. So it's a very, very pleasing position for sports nutrition. And then branded household, we've already talked about that came off to the tune of about 40-50% in the period, which we knew about. Balance sheet, I won't linger on this page unless anybody has any questions, and we can come back to it later, other than noting that the balance sheet is significantly and considerably stronger than it was at year end and certainly the year before. We've continued to pay down our bank borrowings, and our leverage is now kind of less than half a turn of EBITDA. You will see that stock has increased substantially in the period, and we talk about freight and shipping and how the business has been very well insulated, and this is one way in which it has managed that well in terms of just investing in incremental amounts of stock to ensure that shipping delays don't impact our ultimate sales to customers. Now, bearing in mind lighting and batteries where the risk lay, those products, they don't have a sell-by date, they're not particularly fashionable or trendy. You know, there's not a huge risk of obsolescence in investing more significantly in those lines. So it's something that we can unwind as and when we feel we are able to. And if we go into the cash flow, then so all of this should then fall through from everything we've just talked about on the P&L and the balance sheet. We've had increasing levels of operating cash, significantly more than the period before. We've continued to manage our cash flow very effectively, even with the investment into stock. We've continued to service our debt through the ordinary course and paid down some of our related party obligations. The one number that you will see in there that's rather large is the CapEx line, but that's because of the 2 acquisitions that we undertook in the period, the Cymex and Vendec acquisitions. So all in all, pleasing position from an operating cash flow perspective. Sandy?
Yeah. So I'm not going to linger too long on the manufacturing, but today we're manufacturing vaping, powders, and vitamins. So on the powder side, anything that is powder, whether it be pre-workout, whey protein, whether it be meal replacement products, we make it for some of our own brands into retailers, or we make it for private label into retailers. And the same with vitamins. We started with the vitamin C, and we're going to start scaling up next year with a range of more of 30 to 40 vitamins over the next 12 to 18 months. As I said, we're just starting formulating. We've got everything ready, and we've already started with vitamin C now. So I guess there's not much to linger other than vaping has got a lot of spare capacity. We could probably double our revenues from the capacity we have now. The wellness and the vitamins, we will need to make some investments into some machinery, but more for some space, so that we can cater the growth of demand that we're seeing in the first half of this year to carry on. So that's something that we're working to. We get the next slide, please. Yeah, so on batteries, as you can see, it was actually a pretty good performance, because we thought it was going to come off further, because last year we had pretty good growth on batteries due to, we thought, COVID, but it seems like we've sort of stabled and it's a cash cow, and we've got probably more customers buying batteries from us than any other product category. So there's probably over 2,500 customers that buy batteries off us on a weekly or a fortnightly basis. Our business-to-business platform, our website is supremeoffers.co.uk. That's where trade customers buy all our products, and that now is increasing, and batteries being probably about 30% of that website. That's really growing well, and I think we're now about 10% of all our orders now come from our business-to-business platform, of which batteries is the largest part of it. There's nothing more new to add on here. It's just it's stable, and if I go back 5 years, or go forward 5 years, it's going to be turning over between 30 and 40 million. It's going to be in that range, and I think it's quite a stable, mature market. The next slide, lighting. Suzanne pointed out 80% is good, but let's talk about being 10% for the full year rather than 18. I think there was some orders brought forward in September due to energy saving efficiency changing on labels on some of the lighting. So some of the retailers brought in some of the stock in September instead of October. So let's rebalance this to maybe if you look at maybe 10% would be probably a nice sort of steady growth, holding its margin. And we are hedged here. We have a FOB business where we ship our brands like Energizer, Everready, straight from China, straight to Europe, Australia, Middle East, Africa. And some of the brands that we have, like Everready, like Energizer, are really well known outside Europe and in the rest of the world. And we seem to be making better penetration there on our international business. And that has grown from last year, but should grow more next year, because we'll have more trade shows and more places to exhibit our lighting categories. So it's something that's really stable, something that's strong, and something that's still growth, and something we're still excited about is the lighting business. It gets forgotten in our in our portfolio, but it's still a gem. It really is. Managed by a really good manager, a guy called David Nielsen, who's been with it 13 years, who's absolutely brilliant. Next category is vaping. I'm going to go straight on to the next slide, if that's okay, Hannah. I mean, the growth here has been 13%. Now, if you look at last year, they go, oh, well, the growth was a bit more last year. Last year was when we had the prison contract coming in. So for like, that prison contract is matured. It's still growing, but it's matured. So you've got to compare the growth taking out one large contract. So it's still growing organically at 13%. There's been nothing that we've done in this area other than just EPOS data growing, more customers buying it, more customers converting to the 88 Vape brand. I believe there's about 3.5 million vapors, and we believe, based on the average amount we sell, we believe that about 1 million average users of 88 Vape. That's 1 million users of the 3.6. And these are regular users that buy bottles every week. And this is a part of the business that seems like a subscription model. It's so predictable, the week in, week out sales and the trend, that before I get the EPOS data on a Monday, I know what it is from the previous week. I know where it's going to be roughly, and I know where the dips are, and I know when the sort of acceleration starts again. So it is a real strong business. And in terms of market share, we believe that we are still around the 30% in volume. Some of the big tobacco brands are more prominent in some of the big retail grocery chains, like the Tesco's or the Sainsbury's. We're more prominent in discount retail as well as convenient, and now started to motor in the grocery with Asda, Sainsbury's, and hopefully we'll see some more retailers joining that list of extensive customers. It's a brand we own, and it's a brand that we will happily market and sell. And as a switch of 6 million smokers go down, we will see hopefully our 88 Vape sales going. And recently, we'll come on to it, I think one of the questions about the NHS, but there's been an announcement that the government will now introduce this as a medicine in the next 2 to 2.5 years, which actually does a couple of things. One, it's great for the industry, and it's great to get heavy smokers off onto nicotine, another nicotine that's more effective than patches and gums. It also does another thing, is actually it gives the consumer confidence that actually vaping is safer than they thought it was before, because everyone has this perception, or not everyone, the people that haven't given up smoking have this perception that vaping is just as bad as smoking. It isn't. It clearly isn't, and it's 95% safer, but the perception wasn't the same as the 95%. I believe that this now, over the next 2 years, will have a lot more prevalence into consumers thinking that now actually vaping is much safer. And UK being the first country to adopt this, I think if it's successful, and which I think it will be, other countries will start adopting this policy going forward. Okay, so then to move on to the next slide. The wellness category. The growth has been, pretty immense, really. I mean, 192% in the first 6 months. It does come with its challenges. We've got a lot of products going through our factory at the moment. I mean, the amount of SKUs and products and ranges that are going through now is just incredible. And again, the factory have worked really hard to make sure that we've delivered this result, in the first 6 months. And also embed acquisitions that are coming in as well, like the likes of Cymex that's joined our brand. I'd like to break this down into two divisions, really. The wellness of the powders, which I talked about, which is at the moment a significant part of the business, and then the vitamins that are now only just started to come into play in the last 6 months, really. See this category growing. We see that we've got a strong foothold, whether we survive private label or whether we make brands the customer buys our brand. We see that this is going to carry on growing. We've adapted Amazon as one of probably our top 10 biggest customers now in this area with the Cymex brand. And we see that generating more business through some of our other brands on Amazon, where it doesn't have an impact on our retail customers. I'd like to move on to, okay, so this is a new launch of both Sea Lions and Millions. We launched Sea Lions end of July, and I'll cover that off. Loads of questions on that already in terms of the performance. We've delivered between 25 to 30,000 orders since August till today. We've had 2 TV advertising campaigns. We're seeing a 10% conversion when we do a TV campaign. So every 100 people that come on the website, 10 order. We're seeing a repeat customer, which is really bizarre because if you're buying a year's supply, you wouldn't think you'll see them for another year. But what they're doing, they're coming back and buying different products because we're adding more products to the range. But they're also buying for their family or their loved ones. So they're extending the range, their portfolio to not just themselves, but buying for other people in their family. We're also seeing a lot of new users. So we're not just taking market share from the big brands, and 65% of the vitamin market is private label. We're seeing new users come in and never bought vitamins before. The biggest obstacle, I guess, is the price that we sell it for, because it's so low. Is getting the message across that actually it's the same quality. We're not that we're really, really cheap or low price. It's just that we believe that everybody else, especially the big brands, are overpriced and too expensive. And that's the sort of Sea Lions. We think this is going to carry on growing. We're going to carry on investing in our brands, in this brand. We're going to carry on growing the range. There's about 62 products on our range. We're going to grow that. Probably spring of next year, there'll be another burst of a few other products that are coming on and gradually growing through next year. On the other side of the vitamins is the Millions and Millions. That's launching on 13th of January. We've got the TV advertising campaign. We've got 3 discount retailers that are coming at the bottom of the advert and are launching in January. One of them has already launched, which you will see in Poundland, and there's another 2 discounters that are confirmed. One we have orders, one we have forecasts and commitments going live in January. We believe we've got the best 3 discounters for this brand, and we believe that this, with the Davina McCall advertising campaign and the space that you have in store, will be a great success for the brand. Everyone says, what's the best way to advertise and market your brand? The best way to advertise and market your brand is get it into as many retail stores in front of and the best position. That is the best way. If you look at a typical discounter, they'll have 10 to 14 million people walking through those aisles every week seeing your brand. There's no better advertising than being on the shelves. Then on top of that, you then supplement it with advertising on TV or digital or radio to back that up so that when they do see the advert, they know where to go and to buy it. The third pillar in this is private label. So whilst you're making the brands, you can alter the spec, you can alter the packaging, you can alter the brand, and you can make a private label. And what I like about vitamins in particular is the private label. We could win a private label contract, the consumer wouldn't know any different. Whereas if you win a private label contract on vaping or in sports nutrition or something with taste or flavor, you've got a subjective element. Here you've got the only element of subjective is the back of the packaging. The rest is you swallow it and that's it. So we do sort of like the idea of that. Now you've got to remember that the tablets are all at the moment bought bulk and now started to manufacture with our first products and going into more SKUs. I think B complex is due to start in January. When we have a pool of products and we can then pack it in any format that's required, and that brings down the cost of the raw materials. But also, as we go back in our manufacturing, we believe that we'll have a substantial increase in our margins, but that will come over time as the volumes grow and you go back in your manufacturing, you'll hopefully see top line growing and bottom line growing faster. Let's see. We've done this before with vaping, so I've done it. So we've done it as a team. We know exactly how it all works. We just need to get the scale, and hopefully we'll get that in the next 6 to 12 months. In terms of what you think of our over a year's number, that I'm guessing 1.3 to 1.7 is sort of like a loose target where we'll do vitamins to March 2022 next year. But again, it's not sure yet. We've still got 4 months or 3.5 months still to go through this year. Advertising, we are advertising across 88 Vape, Sea Lions, Millions. We're going to carry on supporting those brands. So when you look at our figures, you go, your gross margin, or maybe it's come down in some of the categories. That's because we've probably put a lot of money in our marketing, which we will not see the benefit straight away. It's a longer term sort of strategy. to build a brand. And we have nowhere near the budget as some of the very big global firms, but we'll spend it very wisely. So whereas a big global firm may spend 5 million on an advertising campaign, we will deliver the same campaign but spend 1 million. And that's not our aim. Is by taking last minute slots on billboards, on TV, on radio. Last minute meaning we have the artworks already. We have a phone call and we've got to make a decision within 2 hours, and we've made that decision in 2 hours. No corporates can do that really, but we can do that. And that's where we'll get 30, 40, 50% discount by taking white space, spare space of inventory that's available for advertising. Do you want to move on to the next slide, Suzanne? Yeah, so I guess really, it's here. I want to just leave it now really for Q&A and questions. Hannah, do you want to feed them to us? I guess we sort of covered the categories, and the 5 main categories, 4 are doing really well. 1 has gone backwards, but the rest are all performing really well. The one that's gone backwards has only a 10% margin.
Thank you both very much. And yes, we have a large number of questions. Let's start at the top. In what financial year will Supreme need to relocate to larger premises?
Right. Okay, good question, because we are looking at that now. We've got 5 warehouses around Trafford Park, and we're looking at consolidating 5 of those warehouses into one bigger warehouse with lots more space. So what it means is a few things. One, it means that we'll be a lot more efficient. We won't have warehouse managers and health and safety managers and forklift drivers in every warehouse. We've got them in just one warehouse. We'll be all closer together as a company, and we won't be shuttling stock left, right, and centre. We're doing that very inefficient at the moment. So we will need to relocate because we're just growing at a pace in the next 12 to 18 months. We have looked at different ways of doing this, and we're getting consultants on board now and how we're going to do that. We think it will happen in the next 18 months, we believe. I think that there will be an element of capex that will go into there. There will be an element of rent-free, but there'll also be an element of efficiencies that will come through. But the biggest efficiency we'll have is we can do more Cymex deals, because we will then have a much bigger space to consolidate and buy businesses and integrate them into Supreme, because we've got the space to do that. We haven't got that space and capacity in luxury today to do another Cymex. But we can buy acquisitions, but let them carry on running as they are. We wouldn't integrate them today. We'll do that later. Suzanne, anything to change? I'll add on to that because it's quite
no. I think you've covered it, and I would agree. I think we'll be signing a lease or signing an intention to enter into a lease fairly soon, just because of the time that it takes for these great facilities to be built out. But in terms of when it starts making a difference to us, either operationally, i.e. we will have physically moved, or financially, because we'll be starting to pay it. I think Sandy's absolutely right. 18 months feels about right.
Okay, thanks. Can you please provide the rationale for the acquisition of the branded consumer goods division? As on the surface, it appears to be out of kilter with your other excellent initiatives to progress.
Yeah, another really good question. So I think this was about three years ago. We acquired the business. It was pre-IPO. We didn't have the wellness category at the time. It was a distribution business at the time, and we thought, well, it's distribution. It's making 10% margin. It was relatively low price. We paid, I think, 3.5 million for the business, but it sat there with 2.3 million of assets, stock and debtors. So the risk was very low. Even if I bought it and closed it down, I would have lost 800,000. I guess in hindsight, maybe now looking at it, maybe we've got other areas that we really want to focus our energy and strengths on that are much better in terms of where we can manufacture straight away, where we can own a brand and create a brand. There is something changing in that area that we're looking at in terms of bringing in new people to look at how we can maybe work towards more licensing more products in that area. But that's really early days, and it's something that we're still in consulting about.
And the other thing to note on the acquisition is that all that you're seeing there from the segmental analysis is the revenue and the return that segment in terms of by product has returned. What you don't see there on that set of headlines is the cross-sell that's happened into the other categories through those customers as a result of that acquisition. So lighting, batteries, vaping have all benefited from bolting on those that business and that type of customer, largely of which was an untapped customer base for Supreme before that. So if you're looking at the more general return on that specific investment, it's much deeper than just, well, what is the branded household consumer business doing on a revenue basis? And as I mentioned before, yes, revenues have fallen. We anticipated that to a degree. It's more important to look at the net return of the category and also the kind of cross-sell, the opportunity that it's provided in the meantime. Not forgetting, as Sandy said, that 3.5 million bought it, the balance sheet was worth almost that at the time as well. So yeah, it's certainly justifiable.
But also we've cut the overheads out in terms of we don't have a warehouse there now to have a much smaller team. So in terms of net contribution, it's probably very similar to as it was when we bought it.
Mm-hmm. Yeah, exactly. Yeah.
Okay. Next question.
Let's go to vaping. European vaping market is supposed to be worth 5.3 billion. Is there any reason you can't expand into that apart from one retailer in France? That's surely where the growth is.
Right. So actually trying to grow in Europe with vaping is really hard. And the reason it's really hard is because the customers there, or the retailers there that don't sell tobacco, that don't sell cigarettes, just don't want to sell anything or know anything to do with vaping. So they are our main strength in the UK, the discounters. So a lot of the discounters in Germany and France will not sell it. And we've tried to convince them and show what they've done, but they just really don't. And also the legislation in every country is very different. Now, to tackle Europe with vaping, the best way to do it is to buy a business that already selling a lot into Europe, maybe Germany, maybe France, but not a business that's based in Europe, business that's based in the UK, that the main brands are focused on. That may be an option to go into the market, and that'd be an easier, quicker option than trying to win lots of customers over there. And I've seen lots of companies go up, set offices, set lots of infrastructure, and then pull back and then end up going back into the UK because they found it really hard to make it work in a different country. Yeah, just, we are the biggest country in Europe for vaping. Outside, I think America, then UK is the second biggest vaping. And so we are in a very good country.
Okay, following on from that, 88's the market leader in the UK, but on the back of British American results yesterday, pushed that VUs is the market leader globally. It seems to imply that growth in the vaping division has slowed. How do you see the vaping battle in the UK playing out?
Yeah, so I don't think vaping slowed. I think there's a prison contract last year that skewed last year's number, made it look better than it was. For us, I don't think it's grown, and the market's still growing at 5 to 10%. Views, you see the BAT or Big Tobacco, they've got a global reach in terms of they're in every single country in the world. So it's a very different reach to what they have. So I really can't say much more about them and what sort of volume they're doing. But I'll say is that we believe that 1 in 3 vapers vape 88 Vape, and it's ingrained into our customers. They are so loyal to the brand.
One more here then on vaping. Are you planning to extend vaping sales to other related categories like snus? I'm under the impression that snus is a faster growing category than vaping.
Yeah, so we looked at other categories in this area, like nicotine pouches and other stuff, and we've tested it with our customers, and it hasn't gone down particularly well. We've not really done any big sort of launch. We always test things first before we actually go full steam ahead, just as the limitation our risk. Look, if something else takes off, we will be in the forefront. If we believe that our customers and the consumers demand it, we will definitely look at it. And once on this topic on the NHS, I think a lot of people have mentioned it, is just so the process, how it works. We're looking 2.5 years from now, where I think this will become a medicine. For the next year, it will be more research and development, and it'll be submitting ideas and concepts to the MHRA. It will then go to the next stage of testing and consultancy and all the different types of works around it. And then there'll be decisions on which sort of products get accepted. The cost to do this is not going to be cheap. It's probably going to be a region of £500,000 per SKU, which good and bad. It's good in the sense, only serious companies can get into this, and that will have £500,000 to spend on every SKU. Even talking a million investment, maybe £1.5 million investment. The other area is that we believe that companies like ourselves will be putting forward. We are definitely already got our consultants, and we're considering how we're going to move on the next stage on this. I think big tobacco will probably be part of this, but it's one of those where they're actually cause the problems that they're now subscribing back. It's sort of, it'll be interesting to see how that goes about. And then we think maybe big pharmaceutical, maybe even looking at this. So, cards on table, I think there'll be a lot of people, but what it does do is get the very heavy smoker that's probably in ill health to stop smoking by having a very strong nicotine vape, probably much higher than the levels that are legally sold. And then once they've sort of start weaning down to levels that are commercially available in retail, hopefully they'll come to 88 vape. And that's the idea. But, in terms of positive, it's a very positive. I mean, I think it's £9 for a subscription. So we need to make sure that whatever we give is really good value for the consumer, that the medical, the retailer or the doctor prescribes it.
Okay, let's move on to vitamins. How has millions and millions been received? Oh, you're going to launch, aren't you, in Poundland's 800 stores? Are you confident that vitamins is a big market in the discount retail sector?
Okay, so it's launched in Poundland, I think back in I think it was August or September. It's been really successful. They've been overly happy to the point that we are getting more. It's just like to get more SKUs and just add more and more space. And then the advert will give it another boost in January. So it's been really well received that the retailer is very happy with the outcome. That is the only major retailer till January, and then in January I'll have a better idea by end of January how the other retailers are done. Okay,
and sports nutrition and wellness, Berenberg say their back of the envelope figure for organic growth in the 6 months to the period just gone is 80%, which compares to 38% in the previous 12 months. Do management agree with the 80% estimate?
Yeah, it's right. We guided them to 80%.
Okay, thank you. What are you targeting gross margin? Obviously 30% at the moment. What do you think it will be going forward? Do you think sports nutrition and vitamin grows will be countered by costs of increasing scale in the area?
To answer that one, Sandy?
You can answer it. Yeah.
Yeah, it's a really good question. And the couple of things we can be certain of is that vaping and sports nutrition, which are the highest margin categories in the group, are growing the fastest. So sales mix, pure economics tells us that margin will need to expand and will continue to do so. The rate at which it does that will depend on a couple of things. The speed with which, vaping growth versus sports nutrition growth. If it's just pure vaping, the margin will expand more quickly because the margin for vaping, as you'll see in the results today, margin for vaping purely is higher than sports nutrition. But it feels like there's more activity and there's more focus right now on sports nutrition. And it feels like there's more M&A opportunities in sports nutrition versus vaping. But let's see how that plays out. The other complication for sports nutrition is mix within the category as well. So today, the margin has a few things at play. Powdered proteins, which we manufacture, and the margin there is the highest within the category. Vitamins today, which are largely bulk purchase vitamins that we are just simply potting and putting into pouches. So once we move that to scaled manufacturing, that will drive the margin up. We also plan in the next 6 to 12 months to bring Cymex, as the brand that we acquired in the summer, which today is still distribution, into our manufacturing facilities as well. So that will drive margin up. But then if we have great growth on things like our protein snack bar, ready to drink, accessories, all of those are just distribution. So it will depend on which elements of the category grow the quickest. If you were asking us to kind of commit to one of them, your gut says vitamins, but it's growing from quite a small base today. So the rate at which it moves and where it's going to land ultimately, I don't think there's a ceiling on it right now. It will depend on how quickly we can get all of those items off the ground. The only other thing that kind of combats it is what we do in terms of investment, particularly around advertising that today we'll report within gross margin, and anything else that we may need to invest in before we see the growth from a manufacturing perspective. So upwards, certainly. At what rate? TBC.
Polish off that crystal ball, please. Right, okay. Why do you describe Cymex as your best ever acquisition?
Right, so in terms of the best ever, it's it's a brand that when we first started looking at sports nutrition, it's a brand that we looked at for inspiration. It's a brand that we want to be like that. So the fact that we were able to buy that brand was number one. Number two, it's a heritage brand. I mean, I think I must have had 30, 40 LinkedIn requests of other brands saying, well done, congratulations. By the way, do you want to buy my brand? You know, it's really led on a knock-on effect to other consumers. It deals with Tesco's, Sainsbury's, Morrison's, Amazon. Amazon, we didn't have a direct account with. Tesco's, we didn't have a direct account with. Sainsbury's, we only just got a direct account with the vaping. And basically now, all of those customers, we have got a direct account. So that alone adds value, because you go to Tesco and say, I want to supply you this. They'll say, well, have you got an account? No, well, it's no point. It's just too much hard work to open an account. It takes months and months. Buying Cymex enabled them, Tesco's, to open our account at Supreme. So for me, we've now got an account with the biggest supermarket in the country. And that alone is enough. And the payback on this will be hopefully pretty fast in terms of, because we just cut out the overheads. We've had unfortunately, the timing with the way prices have gone up is just, it's just not as perfect as I would have liked. So I would have liked that the way prices would have been a lot more stable. So our margin would have been less because of the prices. But look, maybe that's why the offer came, because of the way prices were coming ahead, and that's maybe why I got the acquisition in the first place. But who knows? I believe that it's one of the best brands in the sports nutrition category. That's why.
Have you done anything to hedge the whey price?
They were covered till January, and we are still in the process of increasing prices where we have to. It's all in progress at the moment. Everyone's in the same boat. No one can buy a product lower price than we can on this. So we're all in the same position. It's whether consumers will move down to us because the other prices have gone up. Let's see. It's too early to say, but we're in a confident position that we believe that everyone should start accepting price increases next year. Okay.
Customer concentration, please. Can you talk a little bit on it and what top 5% account for?
So I think the biggest customer is about 15% of our revenue. We're growing. Last year we grew it much higher than our biggest customer. So I don't know what the top 3 represent, but I know the biggest customer is about 15% of our overall revenues.
Okay, thank you. Any obvious further categories to add? Perhaps CBD might be a good one.
No, CBD, novel foods, has been a real smash up in the industry, and we believe it's more of in the novel food aspect, we believe it's more of a novelty. The CBD, it's just become a bit of some people have done all right with it, but a lot of people have not done very well. So we're going to park that for now, even though we do own the CBD.co whey care, but that's all third party delivered. We don't manufacture or we don't own any products.
What's the incremental investment in advertising in the current year been, please?
In advertising, you can say so.
We're going to spend £1.3 million this year on advertising, and that's largely to support the launch of Sea Lions, which is the largest part of which is a TV campaign, and then the same again for millions and millions.
And just we spent probably 200,000 last year, so it's an extra $1 million that's gone in this year over and above last year, which I think the first year results are still strong even with that. One thing I'd say about mention about acquisitions and whether we raise money, and I think, do you want to just cover that the debt position, Suzanne?
Yeah, it's come up with a few of the other investor meetings, as well as we've kind of, we've talked about Cymex and Vendec, and is there more M&A to come? What does the pipeline look like? What categories are you going to be looking at in terms of M&A? And so coming back to the point around why was Cymex such a good deal, it comes back to this blueprint that we have for M&A in terms of the criteria we look for. And we talked a lot about that criteria at IPO before Cymex was even on our radar. And then when you look back and compare that criteria to Cymex, it literally ticked every single box. So when we think about M&A going forward, because now we're a little bit more well known, there's more opportunities coming over our desks. The board are also extremely supportive of Supreme undertaking more M&A, because it would appear we're becoming increasingly proficient at it, at identifying businesses at a very interesting kind of valuation, that it means it's value accretive for Supreme. We can integrate them very quickly and very succinctly into this vertically integrated platform we have at Supreme, and seemingly they perform very, very well. So it's definitely something we want to do more of. But when you think about M&A alongside a 50% dividend policy, alongside wanting to get a new facility in the next 2 years, which will come with a big kind of capex price tag, and then investing in things like working capital to fuel growth, you can't do all of those things. Today, we're really low leverage, less than half a turn of EBITDA. That's definitely something that we're exploring right now in terms of wanting to just load up the balance sheet a little bit more, so that it gives us the flexibility and the opportunity to undertake that M&A at the pace and being able to capitalize on the opportunities as and when they arise. So I suspect when we sit here in the summer, there'll be maybe a full turn of EBITDA on the balance sheet in terms of debt. That's the kind of area that we're looking at.
So Suzanne, do you want to cover off the admin costs? Will grow same with revenue. I think we covered the overheads on the admin costs. Yeah,
I did it at the start. So I did it, and then we went through the income statement.
Okay.
Thank you. And just if you were to go back to the market, would you include all shareholders, including the small ones who are on this call?
To be honest with you,
Speak to the brokers.
I don't really know how it all works, to be fair.
You're the boss.
Just to know, it's our first year as a public company, this year. So we've set our expectations manageable. Want to make sure, and just that we're being a public company now. We've got a board, we've got a chairman, we've got a whole team. So a lot of the decision processes now is just one more step. So it may take one step slower, but it's one step much safer for the business. So in terms of having the board and having the final step is the best thing for this company's interest, just in case I make some really crazy decisions. So I can't do that anymore.
How much effort do you put into recyclable packaging? Do you make it easy to read and include the info?
Right. So actually, a good question, because Sea Lions is now combustible, but vaping is our 10 ml plastic bottle. We're going to move to a recycled bottle in the next year, in the next 3-4 months. It's not going to add significant cost, but there will be a cost element. And we're going to go to either 30 or 100%. We're looking at all the different options. The problem is availability. So it's not so much what you want, it's what you're available to get, really. And we will look at all our other parts of the business. I think with lighting, we've already taken off all our plastic and move everything to 2 in a box rather than 1 in a box. So we've done that. And Suzanne, cover any of the other things we've done?
It's worth noting that we now have an ESG committee that sits inside the business with representatives, not intentionally actually, but there are now representatives right across the business, because so many people internally and in terms of our staff, really, it's something everybody feels very strongly about, particularly around sustainability, that it feels like it's definitely pushed right to the top of our agenda, not just at board level, not just because there are obligations and expectations from the city, but it's coming, right through kind of our ranks of people internally as well. From a sustainability perspective, especially, we talked last year about we had changed all of the plastic kind of acetate that sat around the CDUs for the countertop display units for vape. We changed all of those to recyclable. Sandy said now that the bottles is the next phase, and that's something that we will almost certainly have in 2022. All the lighting packaging has now been moved to cardboard. We are now working with our kind of partners in China to do the same for batteries. It's a little bit harder in batteries just because of the way the batteries are displayed, but we are doing as much as we can. And then sticking with batteries, we're looking at the kind of continuation of or not of any of our zinc battery ranges that we have, and also looking at being a best in class in terms of recycling batteries. We know that there are requirements for all retailers to collect batteries, but what can we do over and above kind of the standard and kind of retail expectation? We really want to set the standard there, as opposed to just follow what we're required to do. So there are pockets of sustainable kind of initiatives going on right across the board. We talked in our annual report this year about working with some of our customers as well to see where there was opportunities for backhaul being, rather than everybody sending product to customers, and those customers have their own trucks that take their stock from distribution centres right out to their stores, but all those trucks are coming back to the distribution centres empty. Well, but can they come to us and pick up stock on their routes, so that there's less empty vehicles on the road. That's something that doesn't cost either us or our customers any more money, but it means from a sustainability perspective, we are proactively reducing everybody's carbon footprint. So there's lots of things on the agenda right now.
Okay, question about online and specifically relating to vaping, but are you seeing that category growing quickly on an online platform?
Right, so online, just so you know, when COVID's happened, it just went like a hockey stick up. And what's happened this year, it's leveled out. It's literally flat, the online from last year, but I think it went up something like 300% last year. So for leveling out this year to then push next year, you've got to remember with 88 Vape, there's very little we can do to drive traffic to the site other than people coming on the website. We can't advertise it really other than a billboard or a bus. So we can't do any digital marketing or any Google pay-per-clicks. So it's flattened out, but don't forget all that flattened out is based on something that's grown 300% last year. So we're happy that a lot of companies were going back this year in terms of the COVID bounce. That's just stabled, which means to say that those customers haven't gone back to the stores, and yet the stores are selling more than they were last year. So it's a good story all around.
Yeah, we've spent the last 6 months, similar to Cymex, actually making sure that we retain those customers. That as the shops opened back up, we held on to that consumer base. That the people that were coming back to our online store week in, week out, and the guys have done that very, very successfully. To have stayed flat and retained the vast majority of those customers is a great result. Now it's how do we entice them to keep spending and spending more? So there's a lot of exclusive new product development going on that will just serve the website, which means that there is a reason to go back to the website as opposed to taking another option. So that's how we will fuel the kind of increase in momentum in the future for the online webpage as well.
Okay, thank you. Perhaps a couple for you, Sandy, as a major shareholder. One, do you not think it would be better to retain dividends for cash growth purposes? And two, are you under any lockups, and would you be happy to see your stake further diluted on further issuance? Right,
and so I think I'll lock up for 2 years, but saying that, I would, if anything, I'd like to buy more back. If you know, sometimes when the dips were happening, I want to buy shares, but I'm always in a lockup period and I can't. But the board have given me approval to buy more shares, and I want to buy shares as long as we're not in a lockdown period. That's the key. So I don't think I'll be diluting any further. No. In terms of dividends, the problem is we went to the city at the time with income funds as well as growth funds, and we promised a dividend. To change that today now would be unfair. I think it's not fair on the income funds that have invested at the time. I think it wouldn't be really respectful to do that. So I sometimes think back, I wish now maybe we could have done, maybe reduced it a little bit at the time, but it is what it is, and we're there for this year and next year. But let's see what happens next year. Let's see if something comes along. I'm sure we can look at it.
Good. Have Big Tobacco put up prices in vaping?
I wouldn't. I don't know, to be fair, because they sort of isolated to the major supermarkets and convenience. I believe that they've had some changes, and when they did those changes in their development, they have put them up. But their retail price, as far as I'm concerned, hasn't gone up. I've not seen it going up at the moment, but I've not heard of any significant increases.
How long can you keep 88 Vape at £1 per bottle?
Yeah, so good margin for the retailer, at the moment. So I think it will stay there. I mean, just so you know, Asda have put it up to £1.15. I mean, you've got to remember, we cannot control retail prices. So whatever the retailer wants to sell it for, that's up to them. So Asda have decided to sell at £1.15, which is really interesting, actually. And the sales are still really strong, which tells me that they haven't really suffered that much. They're probably making a lot more money now.
Wonderful. Well, listen, thank you to both of you for your time and that extra little bit at the end. I think that's it in terms of the questions. And we'll look forward to hearing from you again in 6 months' time. Good luck in the meantime.
If there's any other questions that I've not answered, please send it to the Investor Centre website, and more than happy, if we can allowed to say it, then we'll give you the answer.
Wonderful. Very kind. Thank you to you both. Bye-bye.
All right. Thank you. Thank you.